Hey traders, Raghi here, and in this free recap video we're going to talk about the after effects of today's non-farm payroll reaction and kind of following along the concept we talked about yesterday in the videos, kind of keeping up with the conversation, which is understanding different time frames and how to absorb volatility during different times of events. And we have times for events, we have types of events. Well, the times are going to be pretty easy to discover. I use a calendar over at the Forex Factory website. I think it's a very easy calendar to use. This is good for anybody trading futures or Forex. It's a fantastic global calendar looking at events from all countries that can affect both the futures and obviously currency markets. Now, we know the big event of the day is non-farm payroll. And we know there's going to be a huge amount of volatility at 8:30. In fact, we know after the 8:30 economic event, not just for that time, but subsequent to that time, we're going to see a tremendous amount of volatility. And oftentimes, it's not going to be great to use intraday time frames, short-term time frames, to absorb the movement. But I'm going to talk to you about two ways that we can gauge volatility. Now, I've talked about the AutoChartist hourly price movement range and daily price movement range before, so we're going to talk about that right now. So what we had was a 29.15 high right after NFP, and that would project a low of 29.02.5 as a minimum expectation. In other words, that is a 12.5 point move, which is the upper end of the hourly expectation for movement any time of today. So in other words, if I know one of the most significant economic releases are coming out, and I know the upper end of hourly price movement range any given time of day for this 24-hour block of time known as Friday is 12.5 points, I will subtract that number from the high as soon as it happens, because I'm not going to be pre-positioned. I'm not going to place a bet before non-farm payroll. I'll use the volatility, something we call catching the wick of the candle. And so we end up with a 29.02 expectation, minimally. So the market goes down and puts a print in down at 28.98 So let me ask you, and I don't know what the answer is, so this is not a rhetorical question, you got to ask yourself. But if on a day like today, you have the accuracy of pinpointing the low within about 4 points, would that be something you would be comfortable with? Could you handle a little bit of volatility around the 2900 level, possibly about 4 points of unrealized loss known as heat? Could you handle that? Would that be a level you'd be comfortable stepping in and buying as an exhaustive projected low? Because that's exactly what happened here this morning. And then we bounced up from there. Now, later on in the day and after the bell rang, we saw another pretty significant move to the downside. Now, you might say, well, Rog, do we project a low again? You could. You sure could. This time the high was 29.10, and you would subtract, again, that 12.5 points, which means right around 28.98, you think, well, maybe I can buy that low again. Well, let me tell you, and I'm not here to ever say that intraday traders go 100%. That's actually misleading. I'm never going to make you think that because it's just not true. We hit 28.98, 28.97.5, and we kept right on going. So that's what I call being steamrolled. We take our medicine, we get out. Your medicine can be as close as 1.25 point to your entry. So you could be jumping in at 28.97.5, 28.98, and say, you know what? I'll give it 1.25 points. That's how small your risk can be. Mind you, you've already had a winning trade on a very similar bounce from non-farm payroll if you even wanted to trade that. So the next thing we would do after getting stopped out, because we would get stopped out, and I think a lot of people in my position don't spend enough time talking about the reality of saying, hey, that strategy just didn't work. And I would really recommend doing the same exact thing we did yesterday, because once that trade didn't work, now we're going to step out to the longer term time frame and say, all right, what would happen if we sold off 32 points? What would happen if we, from that high we saw today, and today's high, we punched up to 29.15, I believe, and a half. So what would happen if we sold off 32 points? We'd end up where? subtract that 32 points, and that's actually kind of a minimum expectation. I mean, we could be close to even 40 points on the move. And next week, I'll talk a lot more about where these numbers come from and how to use them, because they're a big part of where the low would get plotted and what we would want to do with that low. So, and this is very much, again, like yesterday's video. So what would we want to do with that low? Calculate the low, find out where that is, and decide, even on a Friday, I would always say you really want to be a whole lot more cautious on Friday than you are, say, Sunday through Thursday. But on a Friday, are you looking for a bounce? Once the market reaches that what we call daily price movement low as opposed to the hourly. So for those of you who are saying, Rog, I want to skip non-farm payroll, no problem. But for those of you that want to engage it, this is the game plan each and every Friday. Hourly price movement ranges, daily price movement ranges. Where are the exhaustive edges of support? And that's where you have your best low-risk trade and actually the most possibility for reward. I hope everyone has a terrific weekend, and I'll see you in the next update.